So I keep telling you guys that the economic signs that are coming out right now tell us we've got another recession on the way. May sound like I am beating a dead horse here. Some people say that I'm wrong and that it's going to be different this time. But the fact of the matter is, going back to the 70s, every time that the 2-year and 10-year bond yields have inverted, where the 2-year is paying more than 10, we end up in a recession within about 1 year to maybe 2.5 years down the road. Okay? So that happened again today. So now we're talking over the last 3 weeks, 4 different times that's happened, I think, so far. And the fact that it happens and it keeps happening just makes it that much stronger that we are going to be going into a recession. Now, this isn't necessarily a bad thing for you as long as you can keep your job. And in fact, for a lot of you, this is going to pose some very unique and intriguing opportunities going forward. One of the things that we always do to try to pull through recessions is lower our interest rates. So you are going to have the opportunity sometime between now and the end of the next recession that's coming to get the lowest interest rates you've ever seen on your home mortgage. But that's going to be down the road a little bit. There are a few things that you need to keep in mind. By the way, when it comes to this happening again, I thought of something this morning when I was doing that. There's this whimsical video on YouTube called The Angry Rhino, and where there's this bald guy and his friends are putting ice cream cones on his head saying he looks like a rhino. And the second time that they did it on the video, he turns around and screams, "Again!" And that's kind of the way I felt when I saw the bond yields this morning, because this is the deepest inversion we've had at any time since 2007. Granted, we're only talking over a few week period that we've had inversions at all, but still, this is a big inversion. And it means that we're going to be in this for the long haul. So anyway, if you have any kind of mortgage insurance on your home right now, whether it's regular PMI or the FHA's version, which is called MIP, you need to see what you can do to get out of that now, just in case values take a hit. Now, I don't expect this next recession to be as bad as the last one, but in my area, here in the Bay Area, I saw people who had gotten appraisals on their homes in 2006 at $1.75 million, for example, and that house sold in foreclosure at $675. So, and that's in a high-end area, and there was more than a 50% hit in value. My former mother-in-law had purchased a condominium in Concord, California, in the mid-2000s. She paid $320,000 or $325,000 for it, and she got completely underwater. And a few years later, she did a short sale for $85,000. So she lost more than 2/3 of the value that she had in that house. So it doesn't do you any good for us to have low interest rates if you can't take advantage of them. And if you have PMI or MIP right now, that's probably adding somewhere between 0.25% and as much as 1.25%, depending on the type you have, to what your effective interest rate is as far as what your payments are. So it's really important, if you have the equity right now to get out of it, whether you refinance to get out of it or you petition your lender to get it off, take care of that now. And the reason for that is, if things start to snowball out of control, that's going to happen very quickly. And when that starts to happen, lenders are going to get a lot more conservative. They're not going to be as free with what they let you do as far as refinancing to try to get out of it, or they will not be as cooperative when it comes to allowing you to get it removed by claiming that you have the equity because values have increased. You know, over the past, say, 5 years, values in our area here have gone up by a good 50%, in some cases even more. So it's important that you get rid of your PMI and MIP if you can. It is important that if you refinance now, don't pay a lot of fees to get a cheaper rate, because cheaper rates are coming from the market. It's something that I've discussed before. I've touched on it briefly. Generally, when a lender offers you extra fees for an even cheaper rate than what they're willing to offer, it generally takes 5 or 6 years to make up the difference. So in most cases, you will not make up the difference until after the market gives you a cheaper rate anyways, as far as another opportunity to refinance and get a cheaper rate. Now, maybe that works better in my area in California, where it's very easy to do no point, no fee refinances, because our loan amounts are so high that it's not hard to get enough money from the lenders to cover those fees for you. But if you're in a situation where no point, no fee refinances are commonly done, what you should do is look to refinance anytime that you can get a better rate and pay little to no closing costs to get it. Does that make sense? So, let's see. Is that everything I wanted to cover? I think so. We've got the inversion. Recession is coming. That's happened 7 times going back to the 70s. Every time it happens, we get into a recession. We have never gotten into a recession without it happening, okay? These things are locked together. So the fact that the recession is coming is happening. But there are positives. When we had the last rundown in interest rates, most of my long-term clients ended up in the mid-3s on a 30-year fixed-rate mortgage without paying closing costs. And the cheapest rates that we've ever had were about 3 weeks before the presidential election in 2016, and that was just an offshoot of the surprises that we had with the Brexit vote and the markets just scrambling to decide how they were going to react to that. And then after the presidential election, the markets were surprised with the results and rates shot up. So right now, we have better rates than at any time since about November 2016. And as this economic cycle pushes through, you're going to see them even lower. So I don't want to see you paying 3 or 4 points right now to try to buy down a rate even cheaper than you should be. Usually when you bet against those market forces, it doesn't come out in your favor. Think about this. The reason that a bank will give you a cheaper interest rate if you pay them more is because they've penciled out that most of the time that works out to be a better deal for the bank than it does for you. Most people do not ever keep their home loans long enough to break even. I had some clients back in 2012. I know this is a tangent, but it's interesting. I had some clients back in 2012 who wanted to get a 15-year fixed rate for a certain loan amount, and they felt that they would have been better off to pay extra fees to get a cheaper rate. And so what I did is I analyzed thousands of transactions that we had done at the company I was at the time for 15-year fixed rate mortgages at about their loan size. And keep in mind, this was in 2012. The only time since 1992 that a consumer paying extra to buy down the rate even lower would have made out ahead before the market gave it to them for free was in April of 2004. We hit a bottom, and then things started going up from there, and that person would have broken even in around 2009 or 2010. Okay? Because again, it takes 4 or 5 years to make up the difference, sometimes as much as 6. Well, that same person also would have refinanced yet again at a cheaper rate in 2012 when rates dipped with all of the action the Fed was taking with quantitative easing and everything that they did to push those rates down in 2012. So someone betting against the market in that case, in April of 2004, would have had 2 or 3 years of money in their benefit for having made those payments, the extra payment up front. But then again, in 2012, the market still gave them something cheaper than what they would have gotten by paying the extra. Does that make sense? So then what happens in 2012? Well, if they had paid extra in 2012, then they would have broken even in about 2017, but we had cheaper rates in 2016 than we did in 2012. Oh, so no, that would not have been in their best interest at that time. It is possible that if someone in the first week of October 2016 had paid a lot of points and fees to get the cheapest rate possible, maybe they will have come out ahead. But we won't know that for sure until 2021, maybe 2020. And chances are, before the end of 2021, we're going to have even cheaper rates than we did in 2016. Does that make sense, guys? Anyway, if you have any questions about this, shoot me off a message. I'd like to be a resource for you. If you're not in California, I can still give you advice. I can hook you up with an independent mortgage broker who's local to you, who has the same business philosophies that I do. And it's all about working together and getting the best possible outcome for all of us. So I actually wasn't planning on doing this video this morning, but when I saw the economic news, I wanted to get this out there before continuing with the rest of the stuff I have to do today. So send me a message if you have any questions, and I will probably come back this afternoon with the topics that I was actually planning on discussing today. Thanks, guys. Talk to you soon.